Welcome to Talk Tickers, your direct line to understanding what really matters from the latest earnings calls.
Yeah, cutting through the noise.
Exactly. Today, we're navigating the dynamic world of shipping. We're doing a deep dive into Ardmore Shipping Corp's second quarter 2025 results.
And their outlook, which is pretty interesting right now.
Right. Think of it as, a look at how a specialized shipping company is charting its course through all these global trade shifts and market currents.
And this wasn't just another standard earnings call, I'd say. It painted a really vivid picture of strategic growth and pretty robust market fundamentals for them, being a key player in product and chemical tankers.
So we're going to unpack the numbers, right? Look at the strategic moves.
Yep, the strategy, and connect those dots to what it all means for the broader product tanker sector, especially given, everything going on globally.
Okay, let's start with the headlines then. Q2 2025, Ardmore Shipping, they impressed. Adjusted earnings of $0.22 per share.
Which was notably above what analysts were expecting. Beat the consensus.
Definitely beat it. And revenue-wise, they pulled in a strong $72.0 million. Again, significantly beating projections.
Yeah.
Now, it's worth saying, while that was strong, it was down year over year from, let's be honest, an absolutely exceptional 2024 period.
Right. Context is key there. But those TCE rates, the time charter equivalent rates, were also strong in Q2.
Explain TCE quickly for anyone new.
Sure, yeah. It's basically the average daily earnings for a ship after you take out voyage costs like fuel, port fees. Gives you a clean look at profitability.
Got it.
So their MR spot rates, medium-range tankers hit $23,440 a day. Chemical tankers, $20,409 a day.
Pretty solid number.
Very solid. And what's really interesting is the forward look, the Q3 guidance. They're showing even stronger booking rates.
Oh, really?
Yeah, man orders at about $25,450 a day, and that's with 50% already booked. Chemical tankers around $21,650 a day, 65% booked.
Wow, okay.
And management made a point of saying these forward rates are roughly double their cash break even.
Double break even. That says a lot about the potential profit there.
It really does. Speaks volumes about efficiency and profitability right now.
And they kept the dividend streak going.
Yep, 11th consecutive variable dividend, $0.07 per share. Consistent with their policy, distributing 1/3 of adjusted earnings.
Right, that 1/3 payout. And the market reaction, you said it was kind of muted?
Yeah, I'd say moderately positive.
Yeah.
Cautiously bullish is probably the right phrase. It wasn't like a huge jump.
So acknowledging the good numbers, but maybe keeping an eye on the bigger picture or that year-over-year comparison.
Exactly. Acknowledging the beat, but maybe tempering it slightly.
Oh, okay. Let's dig deeper then. Beyond those headlines, Ardmore made some pretty calculated strategic moves this quarter, positioning for the future.
Absolutely.
What stood out to you on their financial strength and where they're headed?
Well, first off, their financial position looks really solid. They reported $243.3 million in liquidity at the end of the quarter.
That's a nice cushion.
Huge cushion. Gives them plenty of room to fund initiatives without, stressing the balance sheet. Super important in shipping. They also reported EBITDA of $22.4 million for Q2. That's earnings before interest, taxes, depreciation, amortization, and ACLIS. Rent, basically a good proxy for core operational cash flow.
Right.
And crucially, their cash break even kept going down.
Even with higher rates and buying ships, that's impressive.
It is impressive, especially in this interest rate environment and with those recent acquisitions. It really highlights their cost discipline.
Okay, speaking of acquisitions, what were the specifics there? What did they add to the fleet?
So they were pretty proactive. They agreed to buy 3 modern Korean-built MR tankers. Total price was $103.9 million.
Korean builds are generally well regarded, right?
Yeah, good quality. Delivery is expected by the end of Q3. And management, they emphasize getting these at attractive prices compared to market benchmarks.
So not just buying ships, but buying smart, adding efficient assets.
Exactly. Strategic additions. High-quality modern ships enhance earning potential and efficiency.
And then there was that big refinancing deal. That sounds significant.
Oh, it was. Really big for their long-term stability. They basically rolled up existing debt into a new $350 million fully revolving credit facility.
Fully revolving, so flexible.
Very flexible. And the terms look good. Margin 1.8%, maturity up to 2031.
2031, wow. That locks things in for a while.
It really does. It simplifies their debt, boosts flexibility, and reinforces that low cash break-even point for years to come. Strong foundation.
So they mostly play the spot market, which can be volatile, but you mentioned they're doing some fixed rate charters too. How are they balancing that?
Yeah, it's a smart way to manage the ups and downs.
Yeah.
They locked in a 3-year time charter for one chemical tanker, $19,250 a day with a top-tier chemical producer.
3 years, that's solid baseline income.
Exactly. Stable, long-term revenue. Yeah. And then, more opportunistically, they added short-term fixed charters for 2 more MISs. So that brings their total MR fixed coverage to 4 ships, averaging $22,500 a day for like 6 to 12 months.
So it's selective. It cushions the spot exposure without locking everything away if rates spike higher.
Precisely. A bit of a safety net, but still lets them capture upside.
Okay, beyond the financials and the fleet deals, what about operational stuff? Investments that actually improve how the ships run day to day?
Yeah, a really big one is their chemical tanker recoating project.
Recoating, what does that involve?
They're applying new high-spec tank coatings. 5 out of 6 vessels are done. The last one's due in Q3. These coatings, they dramatically enhance trading flexibility.
How so?
Means the vessels can carry a wider range of premium cargoes. Think more specialized, maybe slightly corrosive chemicals. Management actually said these ships are practically behaving close to stainless steel tankers.
Stainless steel is the top tier, right, for chemical?
It's the gold standard, yeah.
Yeah.
Handles the most valuable stuff without contamination. But these coatings give similar capability at a much lower capital cost than buying actual stainless steel ships.
So that directly leads to better earnings, higher TCE premiums.
Directly. Plus, the coatings mean faster tank cleaning times between cargoes.
Ah, less downtime, more sailing time.
Exactly. Improves asset utilization and reduces fuel consumption during cleaning. It's kind of a double win for efficiency.
So it sounds like these investments are really paying off in terms of efficiency and making the assets work harder.
Totally. It means more revenue days, enhanced earnings power. And the good news is, most of their planned dry docking for the year is done.
So fewer ships out of service going forward.
Right. Limited dockings expected in the next few years. Now, 2025 dry dock costs are projected at $38 million, but about half of that is specifically for these valuable coatings and other efficiency upgrades. It's not just routine stuff.
That's an important distinction. It's investment, not just maintenance costs.
Exactly. And fleet availability was exceptional, 99% in Q2. Plus, they keep investing in digitalization, AI across the fleet, and shore ops, always looking to improve.
Okay, let's pivot now. Connect all this company stuff back to the wider market. What did Ardmore's management say about the product tanker market outlook? What's the big picture?
They painted a cautiously bullish picture. That was the phrase they used.
Cautiously bullish? Okay.
And they backed it up with several structural demand and supply factors supporting the market. Key themes were, strong refining margins, OPEC plus potentially increasing production, and of course, geopolitics during the pot.
Geopolitics, always a factor in shipping.
Always. Creating those market inefficiencies.
We hear ton-mile growth thrown around a lot in shipping analysis. How's that playing out specifically for product tankers and for Ardmore?
Yeah, ton miles are critical. It's not just how much product moves, but how far it has to travel.
Right. Longer trips tie up ships for longer.
Exactly. And the global refinery map is changing big time. New big refineries opening in Asia, the Middle East, while older ones are shutting down in the West, like in Europe or the US.
So products have to travel further from the new refining hubs to the consumers?
Precisely. That geographic shift means longer trade routes, more ton miles. So even if total oil demand is stable, the demand for shipping can increase. Management pointed to California refinery shutdowns as a clear example.
California needs to import more refined products now.
Record high imports, yeah. And they have to come on long trans-Pacific voyages. That directly benefits companies like Ardmore with ships in the right place.
Okay, that's the demand side. What about supply? Are we seeing a flood of new tankers hitting the water?
That's the other key part of the bullish case. The supply side looks really tight.
How's that so?
Well, the existing MR fleet is, frankly, old. It's the oldest it's been this century, on average. And crucially, the order book for new MRs is incredibly thin.
Not many new ones being built.
Very few. The order book is only about 14% of the current fleet size. That's low. By the end of the decade, maybe half the existing fleet will be over 20 years old.
And 20 years is often when ships start getting phased out or become less desirable.
Yeah, less efficient, harder to meet regulations, sometimes retired. So you've got this limited new supply coming online, facing potentially growing 10-mile demand. That's very supportive for rates long term.
Interesting dynamic.
Plus, we're seeing some larger tankers, LR2s, shifting away from carrying refined products and moving into the crude oil trade.
Why is that?
because the Aframax fleet, which typically carries crude, is also aging and shrinking. So the LR2s are filling that gap. But that means fewer large tankers available for clean products, tightening that market too.
So multiple factors tightening the product tanker supply.
Right. It's structural.
And you mentioned geopolitics again. How does that specifically impact vessel supply or demand?
Well, disruptions like, say, sanctions related to Russia or just general instability, they often force trade routes to become longer and less efficient.
Ships have to go the long way around, basically.
Pretty much. Which effectively reduces the available supply of ships because each journey takes longer. Add to that things like low diesel inventories in Europe, which pushes up the profit margins for refining the crack spreads.
Encouraging more production and shipping.
Exactly. And then you have things like potential new Chinese export quotas for refined products. All these factors are seen as supportive for product flows and tanker demand, at least in the near term.
Okay, so given that environment supportive market, strategic moves, what's Ardmore's plan for allocating capital? How does that variable dividend fit in?
They're sticking to a balanced approach. Focus on growth via those smart acquisitions, reinvesting in the existing fleet to keep it efficient and modern, like with the coatings, and returning capital to shareholders, mainly through that variable dividend, all while keeping debt low. That's key.
And the variable dividend policy, the 1/3 of adjusted earnings payout.
Yeah, that's core to it. It allows them to preserve capital for opportunities that pop up in a cyclical industry like shipping. They can adapt to the market, but still provide consistent, shareholder returns based on actual performance.
Makes sense. So looking ahead, what should investors be watching for? Near-term catalysts.
Okay, a few key things. First, obviously the actual Q3 TCE rates.
Right.
We have the strong bookings, but let's see the final realized numbers.
Right, proof is in the pudding.
Exactly. Second, the successful delivery and integration of those 3 new MR tankers by the end of Q3, getting them on the water and earning.
Smooth integration is key.
Yep. Beyond Ardmore itself, watch those diesel crack spreads, especially in Europe. Changes in OPEC plus crude output could impact things. And any news on Chinese export quotas for refined products, those are the main market movers to track.
Got it. We talked about the market reaction being sort of cautiously bullish, despite the beats and the good guidance. Why do you think it wasn't more enthusiastic? What held it back?
Yeah, it's a good question, right? Why wasn't there a bigger pop? I think while they beat consensus, investors are probably looking at the year-over-year numbers too.
Compared to that monster 2024.
Exactly. So TCEs and revenue, while strong now, are down from those really high peaks. And maybe the variable dividend at 0.07 cents, while consistent with policy, might have been a bit lower than some hoped for compared to past payouts during boom times.
So it's that relative performance looking back as well as forward.
I think so. It's a nuanced reaction. Positive on the execution and the beat, but maybe tempered by those historical comparisons and just general market caution, not just reacting purely to the headline beat.
Right, makes sense. Okay, let's shift gears. It's time for our This Is Not Financial Advice segment.
Ah, yes, the fun part.
Where we pitch an outrageous but plausible trade idea based on today's deep dive. And we have to stress, this is purely for entertainment, conceptual thinking. Do your own homework. Talk to a pro.
Absolutely, not advice. Okay, so given Ardmore's solid Q2, the demand drivers, that thin MR order book, I'm thinking about something a bit complex.
Okay, lay it on us.
How about a short straddle on the crude freight futures ETF, BAE, hedged with a long call spread on ASC?
Whoa, okay. Short straddle on B upstay, long call spread on ASC. Break that down. What's the thinking?
All right, the rationale is this. Management themselves called out volatility, geopolitical, rates, etc. They framed it as supportive, but volatility cuts both ways, right?
Sure does.
So the short straddle on BEE that's selling both a call and a put option at the same strike price on this ETF that tracks tanker rates is a bet on less extreme moves. You're betting that maybe rates stabilize or mean revert a bit after the recent run-up.
So you collect premium if the ETF doesn't make huge swings up or down.
Exactly. Betting against extreme volatility in the broader tanker market, hoping it chills out a bit, that generates income if it stays in range.
Okay, that's the BE part. How does the Ardmore ASC part fit in as a hedge?
Right, so to manage the risk if rates do go crazy, and more importantly, to specifically capture Ardmore's potential upside from their execution, we pair it with a long call spread on ASC, their ticker.
Buying a call, selling a higher strike call.
Yep. Buy calls maybe well out of the money, like 15 strike calls. Then sell even higher calls, say 17.5 strike, for maybe 6-9 months out.
Okay. Why that structure?
This expresses the belief that Ardmore's specific strengths, their operating leverage, getting those new ships working, realizing those strong Q3 rates will push their stock price up significantly, maybe more than the general market.
So betting on Ardmore to outperform.
Exactly. The call spread limits your upfront cost compared to just buying calls, and it defines your maximum profit and loss on that part of the trade. It gives you upside participation with managed risk.
So the overall trade is bet on general tanker rates calming down a bit with the B-wheat short straddle, while making a leveraged bet that Ardmore specifically will do well with the ASC call spread.
You got it. It's nuanced. Capturing premium from potential rate stabilization via BWET, while directly betting on Ardmore's execution and outperformance via ASC.
It's definitely aggressive playing both sides like that.
It is aggressive.
Yeah.
But, if management's cautiously bullish view turns out to be too conservative, and Ardmore keeps firing on all cylinders, this kind of structure could potentially really pay off. It's a way to play sector trends and company specifics.
Okay. Interesting food for thought there. So wrapping up on Ardmore. They delivered a strong Q2, beat expectations, made some smart strategic moves.
Yeah, buying ships, refinancing debt, really fortifying the fleet and the balance sheet, positioning themselves well.
To capitalize on what looked like pretty favorable product tanker dynamics, those refinery shifts, the tight supply picture.
Absolutely. And while the market reaction was maybe a bit contained, the underlying story seems strong. A seed momentum, operating leverage, playing into those supportive fundamentals.
Those long-term shifts, the global trade routes changing, the aging fleet, it does present a compelling case for companies like Ardmore if they execute well.
Which they certainly seem to be doing, focusing on fleet modernization and financial flexibility.
All right, well, remember everyone, this discussion, especially that trade idea, is purely for informational purposes. It is absolutely not financial advice.
Please do your own research. Talk to a qualified financial advisor before making any investment decisions. Seriously.
So what aspects of Ardmore's call or the product tanker market stood out most to you listening?
Yeah, we'd love to hear your thoughts. Thanks for tuning in to Talk Tickers. Let us know what you think.